Good day. In this video, we will take a look at the basics of capital gains tax for individuals. Before we get into the discussion of capital gains tax, let us start off with looking at how it fits into the framework for calculating taxable income. If we look at the highlighted area, we will see that CGT is not a separate tax, so it is included in taxable income through Section 26 capital letter A of the Income Tax Act, which forms the link between the Income Tax Act and the 8th schedule. So the 8th schedule guides us in terms of calculating the capital gains or the taxable capital gain, and then we include that in taxable income through Section 26 capital letter A. Right. Please take note of the terminology used in this video, as terminology for the capital gains tax topic is very important. Now, let us look at the overview of capital gains tax. There are 4 building blocks for capital gains tax, which are an asset, a disposal, proceeds, and the base cost. If any of these building blocks are not present, then the capital gains tax rules are not applicable. It is also important to note that capital gains tax is applicable to disposals of both a resident as well as certain assets disposed by a non-resident taxpayer. Remember, we started off with looking at how capital gains tax fits into the framework and established that it is through the inclusion of taxable capital gain. The focus for our discussion will therefore be on how we calculate the taxable capital gain, and we will do this in these steps. The first step is to sum up all capital gains and losses. So what does this mean? If you have disposed of 3 assets, you determine whether you have a capital gain or a capital loss for each asset separately, then add everything up. So you will have the capital gain for asset 1, you will have the capital gain for asset 2, and you will have the capital gain for asset 3, and so on. If you have more than 3, then you will add up all those gains. You will get to an amount that we call the sum of capital gains and losses. The second step then is to less the annual exclusion. The annual exclusion is a fixed amount. We will discuss what amount it is in the third video where we have our examples, right? If the taxpayer has a capital loss, the sum of the capital losses must be reduced by the annual exclusion. Please note that where a taxpayer dies during the year of assessment, so when a taxpayer dies during the year of assessment, the annual exclusion is a higher amount than when the taxpayer is still alive. The reduction of the sum of capital gains and losses with the annual exclusion will result in an aggregate capital gain. I will continuously remind you to take note of the terminology used throughout the video. So I will repeat. The reduction of the sum of capital gains and losses with the annual exclusion will result in an aggregate capital gain. So if we provide you with the aggregate capital gain in an assessment and require you to determine the taxable capital gain, you should know that the aggregate capital gain would have already taken into account the annual exclusion. If the taxpayer has an assessed capital loss brought forward from the prior years of assessment, then the third step is to reduce the aggregate capital gain by the assessed capital loss to get to the net capital gain. The last step then is to multiply the net capital gain with 40% to get to what we call the taxable capital gain. This is the amount you used in the taxable income calculation. Remember, if you have a loss, so you don't have a net capital gain, but you have a net capital loss, then you will not include anything in taxable income. In summary, you calculate your taxable capital gain by following these 4 steps. Step 1, the first step is to determine the sum of the capital gains and losses. Step 2, to determine the aggregate capital gain, that is the sum of the gains and losses reduced by the annual exclusion. Step 3, determine the net capital gain, that is the aggregate capital gain reduced by the assessed capital loss. And then lastly, step 4, you multiply the net capital gain by 40% to get to the taxable capital gain. Now that we have learned how to determine a taxable capital gain, the next thing we need to look at is how to determine a capital gain or a capital loss, as this is the amounts that are used in the first step of calculating a taxable capital gain. On disposal of an asset, a taxpayer should calculate a capital gain or a capital loss on each asset disposed separately by firstly determining the gross proceeds. Secondly, by deducting the base cost from the proceeds to get to the capital gain or loss. A capital loss scenario would arise if the asset was disposed for proceeds which are less than the base cost. Thirdly, we need to identify whether any portion of the capital gain or the capital loss should be excluded or rolled over. We will discuss the exclusions and rollovers in the next video, so that is in part 2 of the series of the CGT videos. If there's any specific exclusion or rollover, then this should be applied accordingly, and the final result of this calculation will be the capital gain or loss used in the capital gain calculation as the previous slides. Now, there are special rules for spouses married in community of property, in that if the asset disposed forms part of the joint estate, then each spouse will be deemed to have disposed of 50% of the asset. So where you have spouses married in community of property, when they dispose of an asset, they will be deemed to have disposed of that asset equally if that asset forms part of the joint estate. If the asset does not form part of the joint estate, the spouse that disposed of the asset will include the capital gains or losses in their taxable income calculation. The basic rule is that the amount for which the asset is sold represents the proceeds. So the proceeds is equal to the amount for which the asset is sold. Beware that the taxpayer receives a net amount, that is after taking into account the commission. The proceeds will be the gross selling price and not the net selling price. So where a taxpayer receives a net amount for a sales transaction, the proceeds will be the gross proceeds before taking into account any other item and not the net selling price. Any transaction costs should be included in the base cost and not deducted from the gross proceeds. Also take note that where a portion of the amount received is subject to income tax, it will not be subject to capital gains tax as well. A typical example of this would be your recoupment. The next item that we discuss is the base cost. So the base cost in simple terms is the cost of the asset. There are certain expenses which may form part of the base cost and some which may not in terms of paragraph 20 of the 8th schedule. The base cost of an asset acquired before the 1st of October 2001 is determined differently from an asset acquired on or after the 1st of October 2001. The reason for this is because capital gains tax was introduced in our legislation on the 1st of October 2001. The 1st of October 2001 is referred to as the valuation date in the Income Tax Act. In all cases, meaning whether you are dealing with a pre-valuation date asset, meaning, and that is an asset that is acquired before the 1st of October 2001, or a post-valuation date asset. A post-valuation date asset would be an asset acquired on or after the 1st of October 2001. In all these cases, expenses which are revenue in nature, like repairs, will not form part of the base cost. In the next slide, we will discuss how the base cost of an asset acquired before the 1st of October 2001 is determined. The base cost of an asset acquired before the introduction of capital gains tax on the 1st of October 2001 is the sum of the valuation date value and any allowable cost incurred after valuation date. The valuation date value, meaning this amount, is the value of the asset on the 1st of October that is determined by paragraph 26 or 27 of the 8th schedule, depending on whether the taxpayer is in an historical gain position or a historical loss position. We will discuss what a historical gain position means as well as what a historical loss position means. Right. Paragraph 26 of the 8th schedule applies where the proceeds on disposal of a pre-valuation date asset exceed the sum of allowable expenditure incurred before valuation as well as allowable expenditure incurred on or after valuation date. So, paragraph 26 would apply where the proceeds of a pre-valuation date asset exceed the sum of allowable expenditure incurred before and after the on or after the valuation date. This is a scenario that we refer to as the historical gain situation. And that is where paragraph 26 applies. Or where the taxpayer cannot determine the expenditure incurred before valuation date, then they will also apply paragraph 26 to determine their valuation date value. If the taxpayer cannot determine the expenditure incurred before valuation date, they can select the valuation date value as either the market value or 20% of the proceeds less allowable expenditure. So where a taxpayer cannot determine the expenditure incurred before the valuation date value, they have two options: to either use the market value or 20% of the proceeds less allowable expenditure. So they will select any of these two options depending on which is favorable for them. Right? And then if the taxpayer can determine the expenditure incurred before the valuation date, then they can select any of these three amounts. So they can select the market value on valuation date, So for assessment purposes, the market value will be provided, or they can select 20% of the proceeds 20% of the proceeds less allowable expenditure incurred on or after valuation date. So this A would refer to allowable expenditure that was incurred on or after the valuation date, right? And then the last option is TAB, which is short for time apportionment basis. This is a method for there is a method for calculating TAB, but as we do not expect you to be able to calculate it, it will be provided during an assessment. What you need to know then is how to use it. So if a taxpayer can determine the expenditure incurred before the valuation date value and they are in a historical gain position, they have the following three options to select from. So they have the market value, 20% of proceeds less allowable expenditure incurred after on or after the valuation date value, and then lastly TAB. Right. And then if market value is selected and proceeds do not exceed the market value, then the valuation date value is the proceeds less allowable expenditure incurred on or after the valuation date. This is an exception to the rule. So if a taxpayer has these three options and they select the market value, right, then they select the market value. The next question that they need to ask themselves is, does the market value exceed the proceeds, right? If the market value does not exceed the proceeds, then they cannot use the market value as their valuation date value, but they will have to use the proceeds less allowable expenditure incurred on or after valuation date as the valuation date value. Right. So we have discussed how paragraph 26 works. So just a quick recap, it works for taxpayers that cannot determine the allowable expenditure incurred before the valuation date value, as well as a scenario where a taxpayer is in a historical gain position. Right. Paragraph 27 now applies where the proceeds on disposal of a pre-valuation date asset do not exceed the sum of allowable expenditure incurred before valuation, as well as allowable expenditure incurred on or after valuation date. This is a scenario that we refer to as the historical loss situation. In this scenario, there is no election by the taxpayer. So as opposed to paragraph 26, where the taxpayer had to elect one of the options, there is no election here, and the valuation date value will be determined in the following manner. So if the market value cannot be determined, so that market value would be the market value on valuation date, right? If the market value cannot be determined, then the valuation date value is TAB. That's it, right? If the market value can be determined, then the taxpayer needs to look at their allowable expenditure before valuation date. If the allowable expenditure before valuation date is more or equal to the proceeds and is also more than the market value, then the valuation date value is the higher of the market value or the proceeds less allowable expenditure incurred on or after valuation date. If that is not the case, then the valuation date value is the lower of the market value or TEP. Remember, we will provide the market value to you. We will also provide TEP. You need to know how to use it. Okay. Remember this slide. The whole purpose of the previous 4 slides was to provide context on how to determine the base cost of an asset. Please look out for the next video in which we discuss the different exclusions and rollovers. Thank you.